So, you're thinking of giving your children a bit of a head start in life? Maybe with a gift of property or some shares? It's a wonderful, generous thought. But hold on, because that very act of generosity could land you with a surprise tax bill, potentially for tens of thousands of pounds.
If the answer is yes, or even just a maybe, then you're going to want to stick around. Honestly, getting this wrong is one of the most common and most costly mistakes we see families make. But the good news is it's completely avoidable if you know the rules.
And to help you navigate these tricky waters, we've teamed up with the tax experts at My Tax Accountant. Together, we've put together this straightforward guide to break down exactly what you need to know about gifting assets in the UK for the 2025 to 2026 tax year.
All right, here's what we're going to cover. First, we'll uncover the hidden cost lurking behind a simple gift. Then, we'll get into something called the connected person rule. It's super important. We'll walk through a real-world calculation, then show you the tax-saving tools you can use. And finally, we'll cover the crucial paperwork and why getting expert help is a really smart move.
Okay, let's dive right in. The problem starts with a simple, generous act. But you see, where you see a gift, HMRC, the tax authority, sees something quite different.
Now this is the absolute kicker, the one thing that catches everyone out. Even though not a single penny has changed hands, HMRC looks at the situation and says, that's a disposal. They treat it as if you sold that asset for what it's worth today. This creates a paper profit, what's officially called a capital gain, and yep, you guessed it, that's what they're going to tax you on. So you might be wondering, okay, but why? Why is a gift to my own son or daughter treated like a commercial sale? Well, it all boils down to a specific bit of tax law called the connected person rule. Let's unpack what that actually means. This term connected person is everything in this conversation. It's not just jargon, it's a legal definition that triggers this whole tax process. If you give an asset to anyone who fits this description, that market value rule we just talked about automatically kicks in. It's not a choice, it's the law.
Let's be crystal clear about who we're talking about here. It's your immediate family line, up and down. Parents, grandparents, kids, and grandkids. It also includes your brothers, sisters, and your spouse. But look closely at the note at the bottom. Your aunts, uncles, nieces, and nephews are not on this list. Gifting to them can fall under different rules, which is a really important distinction.
Right, enough with the theory, let's put some real numbers to this, because that's when it really hits home. We're going to follow a story to see exactly how this plays out in the real world. So, let's meet David. He's a business owner in London, and years ago, he bought shares in his company for £50,000. He's done well, and now they're worth a cool $350,000. He wants to do the right thing and pass them on to his daughter, Chloe. And because Chloe is his daughter, she is, without a doubt, a connected person.
Here's how HMRC's calculator works this out. Step 1, they take the market value today. That's £350,000. Step 2, they subtract what David originally paid for them. That's £50,000. And voila, that leaves a capital gain of £300,000. Remember, it's a gain on paper, but the tax is very, very real.
And here's a little pro tip for you. And honestly, this one is huge. The tax point, the disposal date, isn't when the lawyers finish the paperwork. It's the day you make the agreement to gift the asset. If you're dealing with assets that fluctuate in value, getting that date right is absolutely critical. Timing really is everything.
So what does that $300,000 gain actually mean for David's bank account? Well, assuming David is a higher rate taxpayer, and after we factor in his small annual tax-free allowance for 2025/26, the potential tax bill comes to a jaw-dropping $71,280. A simple act of kindness now has a massive, immediate price tag. Okay, take a deep breath. I know that number is a shocker, but please don't panic. This is not the end of the story. There are legitimate HMRC-approved ways to manage, reduce, or even eliminate that bill. So stay with me, because understanding this next part could literally save you thousands.
Luckily, you have a couple of powerful tools in your tax-saving toolkit. The first is the annual exempt amount, which we've already mentioned. The second, and this is the big one, is called gift holdover relief.
First up, the simple one. Everybody in the UK gets a small amount of capital gain they can make each year, completely tax-free. For the 2025-2026 tax year, that's £3,000. It helps, of course, but as we just saw with David's situation, when you've got a massive gain, $3,000 barely scratches the surface.
But now for the real game changer, gift holdover relief. The best way to think about this is like hitting a giant pause button on the tax bill. The tax doesn't just vanish into thin air. Instead, the person giving the gift, David in our story, gets to hold over the gain. The responsibility for the tax then cleverly passes over to the person receiving it, Chloe, and it only becomes payable when she eventually sells the shares down the line.
And this is what it looks like in practice. The difference is just staggering, isn't it? On one hand, David is facing an immediate, painful check to the taxman for over £70,000. But on the other hand, by claiming this relief, his immediate bill drops all the way down to zero. The tax is simply parked for the future, giving the family huge financial flexibility.
Okay, so this relief sounds amazing, right? A total lifesaver. But, and this is a big but, using it properly means you have to follow the rules and the reporting process to the absolute letter. Knowing about the relief is only half the battle.
These aren't suggestions. They are absolutely critical steps. First, you can't just guess the value. You need a formal, professional valuation. For a house, that's a risk surveyor. For shares in a private company like David's, you need a specialist. Why? Because you can bet HMRC will be scrutinizing that number. Then, you have to report the gift, and if any tax is still due, you have to pay it.
Now, speaking of rules, you need to burn this timeline into your brain. For gifts of UK residential property, you have just 60 days, that's 2 months, from the date of the gift to report it to HMRC and pay any tax you owe. That is an incredibly tight deadline that catches so many people out.
Right, we've been through a lot, from the scary hidden tax bill all the way to the powerful solutions available. And that leads us to our final, and honestly our most important section of all. Look, the key takeaway from all of this is simple. While you're now way more informed, this knowledge should be your signal to seek expert help, not to try and handle it all yourself. The rules for these reliefs have very strict conditions, and the penalties for getting it wrong can be severe. Professional advice isn't a luxury here, it's an essential part of the process.
And of course, we have to say that everything we've talked about today is for general guidance. Tax is complicated, and everyone's personal situation is unique, so please don't use this as a substitute for proper advice tailored specifically to you.
So, what's the next step? It's talking to an expert. Before you make any decisions, we strongly recommend you consult a professional. The team at My Tax Accountant are brilliant and can give you advice that's built around your exact situation. You can call them on 0208-570-8531. Again, that's 0208-570-8531. Or you can drop them an email at info@mytaxaccountant.co.uk. And for more helpful guides just like this one, make sure you hit that subscribe button on their YouTube channel. Thanks so much for watching.